Hello, welcome back. And you're listening to the Royalty King. Guys, just landed in Miami last night, and so I've been putting together some work today, giving you a little bit of an update. One update I think is important because it signals kind of opening and adding some more exposure to the portfolio in a different sector, will be my addition to royalties, obviously, that are not directly involved with the energy sector. So we've still got the royalties, a little bit different. You guys, I think, you're going to be interested in what I have to say today. So if you've been looking through the portfolio, one of the portfolios, you'll see a couple of music/entertainment royalties, a Universal Music Group and Warner Music Group. But in particular, the focus of today's topic is around pharmaceutical and biotech royalties, which would be large beneficiaries of AI. So Halozyme Therapeutics, Genmab, and then down the bottom one we've owned in the past, Royalty Pharma, took some profits on that, and now I've got just a tracking position, starting position there, and then a starting position on Halo and Genmab. So not a large position by any means, but it's something that I wanted to explore a little bit deeper today with you guys. So I want to share my screen with you on a little bit of a presentation that I've put together just to kind of, there we go, just to kind of show you what I'm thinking. And if you haven't subscribed already, what are you doing, guys? Please subscribe to the YouTube channel and the Substack for more information below. So let's go through it. Slideshow. Finally, here we go. Disclaimer, obviously nothing I say or do is advice. It's just me documenting my opinions out there so you can take a look and hopefully get some entertainment value out of it. That's all it is. So it's interesting. The AI beneficiaries that we've been talking about, everyone's talking about the NVIDIAs of the world, the AI companies themselves, OpenAI, ChatGPT, all this type of thing. We've been positioning in terms of what I think are going to be the true bottlenecks, which are the input sources to power the incredible amount of electricity that these companies will need, in addition to their water supply, places that will need to be off-grid, and with a land mass or a land surface that's going to be suitable. And ideally, with all of these combined, so energy inputs, water for use in the electrical generation through the turbine and cooling, and then of course the land. So these would be your land bridges, your TPLs of the world. We've been positioned there for quite a while, and very, very happy. I think we're only haven't even scratched the surface in terms of what can happen in those types of royalty companies. So biotech and big pharma, what's so interesting here? AI, as I've been learning, is kind of divided between large language models, so your search functions, ChatGPT, Perplexity, Grok, all those guys, which everyone knows and loves, and then your large mathematical models, or the quantitative side of things. One can create new sequences, but the other can't. So the search functions can go through everything that's basically been published and can search and screen based on your directions as the user. Large math models are a little bit different. The ChatGPT can't really create a new molecule as such, like a large mathematical model can. So if you're putting in inputs, the lab rats down in the biotech world, I believe, I have it understood, are starting to program different folding processes in a protein, for instance, and that's going to be important in terms of figuring out which type of new molecule, which folds are going to be needed so that they can bind to an active receptor site. Okay, and so to give you an idea of the different permutations, AI is calculating all these different types of protein folding possibilities on the one protein, and the valence electrons, when they interact with the valence electrons of another molecule, can just form an unfathomable amount of different permutations. So from what I read, I'm certainly not a biotech expert, but these shapes, in terms of the different permutations, can end up being 10 zettabytes. And so if you've got one and then 21 zeros followed, that's 1 zettabyte. Okay, so obviously an enormous amount of combinations. So why is that important? What has that got to do with anything? Well, at the moment, if you're looking at R&D, drug discovery, and all the capex that's being put in to develop new drugs. They're spending billions and billions and billions of dollars, and it's a very large expenditure as a percentage of the budget for the large pharmaceutical curves, right? And unfortunately, it doesn't have a very good success rate. It takes ages just to get a drug to the first phase, second phase, third trial phase, and the failure rate is through the roof. So if you have somewhere around 20 different drugs that get through the first stage, and you whittle down, it ends up being like one in about 20, 18 to 20 of these new drugs that are put forth, which have already been scrutinized by the scientists and the biotechs before they even get to that stage. The failure rate is extremely high, and of course the costs of that are also extremely high, commensurately. The application of AI to simulate a lot of these folding possibilities before they're put forth into these later trial stages is obviously going to be huge. AI can work around the clock and is better at identifying these molecules that will pass through the testing stage. It's faster, it's cheaper, and therefore less wasted R&D. And at the end of the day, the idea there is that it will be an increased profit. If you're not wasting so much of your capex budget via R&D to develop new drug, new treatments in order to grow, then more of that revenue is going to fall to the bottom line, which is what we want as investors, and it's what we want as consumers also, so that the capital can be allocated where it needs to be to develop new treatments. So if we're looking at this and we're thinking, okay, maybe the pharmaceutical guys are going to have a better time over the next, who knows, 5, 10 years, 15 years, 20 years with all this that's happening, maybe, but you don't want to be a pharmaceutical expert, you just want to capture the market beta. One, understandably, might look towards the ETFs to get some broad blanket exposure to that particular sector. And if you look at some of these, there's not an awful lot of capital. There's less than 12 billion across. I've picked to select kind of 5 that I think are the most important. Obviously, there's a few more than this, but the point is you'll look at this and you'll see there's really not an awful lot of capital in the public markets being thrown this way. And obviously, I'm looking to get exposure to any of my themes in a capital light business that has call optionality on the upside. So a royalty or a streamer type business is obviously my preferred way to express this theme. And if you're looking through these, all I could find in terms of royalty exposure that is of any significance would be in the last one there, the PBE, Invesco, Biotech, and Genome, which has the Royal Pharmaceutical stock, and it's roughly 5% of that particular ETF. I've called this lack of ROI in R&D. So it's looking at how much R&D is as a percentage of the budget. So you're looking here at almost, not quite a third, a quarter for the pharmaceutical industry. But if you compare it to the semiconductor industry, which is often thought of to be an extremely capex heavy sector, which of course it is, that industry has a huge cost of its growth. So yes, NVIDIA can grow, but if you look at how much it costs in terms of R&D and to develop the new chips to fund that new growth is really quite heavy at, say, 15% according to this chart, sometimes around 20%. Pharmaceuticals is 10 percentage point higher than that. It's actually quite surprising when you look at just how capex heavy or R&D heavy this industry is. And then if you look at the chart on the right there, you'll see if it wasn't bad enough that it's so capex heavy or R&D intense in terms of being able to fund the growth of the revenues, you're looking through here and you're seeing the return they're getting on that R&D spend is just diminishing, and you're getting a 1.7% yield according to this chart, at least in 2020. So anything that can be done to improve that yield is obviously going to be beneficial. Okay, so here's the ETFs, and if you look over the last 5 years, they haven't really had a happy time of it, and it's probably not surprising. If you look at the ARK, poor old ARK vehicles there, it's down, you're underwater 52% from the starting point. And if you're looking at their current valuation ratings, even though they're sold off a lot, they're still kind of around that sort of 16 to 18 range, which would be a kind of normal to slightly expensive general broad stock market. I know we've been through some historically weird times with the S&P being, like 30x plus PE multiples, but These, I think if you're comparing this to the S&P and saying, oh, this looks like decent value, I'm really not so sure. You'd have to get a strong amount of growth coming through to justify that for an ETF, in my opinion, anyway. So let's take a look at the big pharma, the big boys. Now, if we're looking at this from an energy perspective or commodity miner perspective, we'd call these the producers. So they have the operating interests in going through and developing the drugs, selling the drugs, basically, and obviously the huge conglomerates that have a vertically integrated chain. So as big, I guess, super majors, if you were to compare the energy sector to these guys, the Exxon, the Chevrons, these guys would be the super majors of the pharmaceutical industry. Now, if you look at their 3-year average net margin, it's actually pretty good. I mean, I've seen a lot worse than that. And if you look at their ROIC, you've got double digits there. And that over the long term is really what's going to determine your return as an investment. So 3 years obviously is not long enough to hang your hat on. But it is interesting because if you look at this next chart, you'll see, this is albeit a 5-year chart, you'll see that barring Johnson & Johnson down there, which is an exception to this, Abbott and Lilly have, kind of kept up in terms of their ROIC, what you'd expect in terms of the compounding of their stock prices. So I thought that was interesting to note. So you might say to yourself, okay, well, maybe you want to be involved and invest in some of the producers, the super majors, as I've called them, of the pharmaceutical industry. And you could. The issue is, how much room do they have to grow, and how much talk do they have to that growth in terms of a base effect? So they're obviously much, much larger companies, 731 billion, Eli Lilly. It's going to take a lot of growth to really move the needle on these guys. And what's the market currently wanting you to pay in order to buy these stocks? So if you look at the EV to EBIT, or if you look at the estimates to free cash flow, the cheapest is Johnson & Johnson at sort of let's just say 4 to 5 times free cash flow. Somewhere around that would probably be appropriate. Now, in the current environment where you're not really getting a lot of cash, some investors might actually find that attractive if they believe that Johnson & Johnson is a stable company that can grow at a reasonable clip. But it's hardly a basement bargain. So now you're going to say, okay, well, the Royalty King is going to look for royalty, and obviously I am. If we look at 3 select royalties in the space that are interesting, they're on the cusp of, I guess, pharma/gene modifying biotech companies. Their average net margin and 3-year ROIC can be seen on this particular chart. Okay, so they've got really strong margins. Apart from Royalty Pharma, it's got some issues with a little bit of debt and with some of their legacy royalties due to open up at the end of the decade, whereby they won't have exclusivity on them. And the return on invested capital is really, really good. It hasn't been reflected, however, apart from Halo's price, over the last 5 years. So yes, Halo's done really well. But if you look at the other two, the rule doesn't appear to hold, at least as of now. But obviously, the past is the past, and we have to look towards the future. So the super majors are trading at obviously I guess an exuberant, if not enthusiastic, multiple. And when you look at these guys today, I just want to draw your attention to a few things. So one might be the enterprise value, and GMAB is available on the NASDAQ, but I've just got the Danish kroner in here for some silly reason. But these guys, nothing over 25 billion in terms of the size of the company. All right, so that's around your Texas Pacific. Obviously, it's a completely different sector. But if we compare them to the previous super majors, obviously they're like a tenth of the size of those particular companies. So there's room for the needle to be moved if they can get the growth rates, and we know they've got the margin. Now they just need to put it together. And I'm thinking that these guys may be, I guess, free rider beneficiaries of the AI boom. So it's not going to be them that's going to be spending the capex and all the AI. It's going to be the super majors. And where these guys come into it, I suppose, is being able to more accurately allocate their financing capital in terms of finding the best royalties for the future treatments that they're going to benefit from. And obviously, all the extra capex is not going to come out, or normally speaking, is not going to come out of their budget, at least not to the same extent as the actual research team, the R&D aspect. of the line items of the super majors. So smaller company, much smaller valuations. So PEs, single digits, which is pretty incredible. And these companies are tipped, all of them, to grow more than double digits out to the end of 2030. So this is really quite crazy. Price to free cash, obviously you can see there basically a 20% yield for Royalty Pharma. If the analyst estimates do come to measure, I'm using analyst estimate here, not my own. Even an 8% free cash flow yield in today's current yield-starved world for Genmab is really interesting, especially considering it trades at half its tangible book. Halo, same kind of deal. So here you've got analyst estimates for year-end target price. I would ignore them over 1 year, and I'd start to look at what the issues behind each individual company is. And I know from my cursory glance thus far that Genmab is trading very cheaply because the market is not convinced it will be able to find new exclusive royalties past the 2030 date, and it feels that is going to impact its earnings, which it may do. I need to do a much deeper summary on each of these three names, but I hope that you found that interesting and insightful as to where I'm looking to place my capital. So if we take a step back, the chart that I showed you before was over 5 years. Now we're looking at over 3 years because I've done the ROIC for 3 years. The gap starts to close, particularly with Halo and Royal Pharma starting to hit their stride. So it'll be interesting to see in another 2 years what these companies can do and how they can be beneficiaries of AI. So very small startup position, but it's a theme that I'm keeping my eye on. And if I start to feel like I've got much more conviction around it, I'll look to add to each of these weightings as I've got the ability to do that in the portfolio. So I hope you guys really enjoyed that. If you haven't already liked and subscribed, please do so. And if you're wanting more exclusive content and deep analysis on in particular names, then do check out my Substack. Link will be in the description. Take care, and I'll see you again next time.